Hi, I'm Jonathan Fallick, the CEO of JF Capital Advisors. JF Capital is a strategic and capital markets advisory firm. We've completed over $35 billion worth of hospitality transactions, including over $1 billion as principals. In these chaotic times, in these unprecedented times in the industry, where the majority of hotels have either shut down operations or gone to very limited occupancy and very limited staffing, we've been getting a whole lot of questions about loans, restructuring loans, compliance with loan agreements, and what borrowers and owners should be thoughtful of and what they should be concerned about as they try to restructure their way through or manage their way through this crisis. None of what I'm about to go through should be construed as legal advice or transactional advice. Every loan agreement and every borrower situation is different. You should consult with your attorney, with your advisors, with your bankers, and any other competent professionals. If you'd like to reach out to JF Capital Advisors to discuss your loan, your loans, or your situation, please contact me at jonathan@jfcap.com or by phone at 917-238-6917. So what's going on? Borrowers are going to lenders and asking for relief. The biggest problem that most borrowers have right now and that most lenders have is there's no clear outlook on what's going to happen in 30 days, 60 days, or 90 days. The government has taken unprecedented action, but we're really in muddy waters where no one has clarity on when the economy will reopen, when there will be professional sporting events again, when there will be international travel, when there will be large group business. So we're in the dark, and what we've been advising a lot of our clients is to go to lenders, and we're seeing a number of similar requests, and they generally involve some or all of the following: a waiver of 1 to 3 months of debt service, a deferral of 3 months of debt service, a suspension of any of the debt financial covenants, a waiver of any of the financial covenants for a 1-year period, a waiver of any required financial reporting for borrowers or guarantors that would be triggered by any financial covenants, waiver on a temporary basis of guarantor net worth and liquidity covenants, and short-term extensions of maturing loans if the loans are maturing in the next year or so. We're also advising clients to ask for ability to use some of funded reserves, if they're funded FF&E or other reserves, in order to pay operating expenses. And then finally, we've been asking each lender for approval in advance to either shut down the hotel if necessary or reduce the operation substantially so that there's limited staffing. We're obviously not operating in accordance with normal standards, but want to make sure the lender is aware of what we're doing and why we're doing it. And finally, we've been asking for approval to take PPP loans under the CARES Act, which might otherwise violate loan provisions. So at a certain point in time, the economy is going to turn back on, business will return, some of it quickly, some of it very slowly, and we'll make it through this. There will be a lot of restructuring and repositioning going on then as there's more clarity on behalf of borrowers and lenders. However, as we think through shorter term situations, it's very important to be mindful of a number of the provisions that are in loan agreements. I'm going to run through them in no particular order, and again, every situation is unique, so do not take any of this as legal advice, transaction advice, financial advice. This is presented for informational purposes and illustrative purposes only. In almost all loan agreements, there's a concept of approved operating expenses. Those are approved as part of the annual budget process where the budget gets submitted to the lender and the lender approves the budget. I'm fairly certain that no one's 2020 budget had a meaningful expense for severance, for payouts of accrued vacation days in connection with layoffs or furloughs. And at some point in time, lenders are going to ask for revised budgets, and the operating expenses in those approved revised budgets are going to be very important to focus on. What else? Cash sweep triggers. So many loan agreements have cash management systems where once you achieve below a certain debt service coverage ratio measured on a trailing 12-month basis, cash will be swept into a lender-controlled account and maybe pooled there and held there. It usually requires being above a certain debt service coverage ratio trigger for an extended period of time to free up that cash. So in these already challenging times, it's highly unlikely that by the end of Q2 of 2020, that almost all mortgage loan borrowers who have debt service coverage ratio covenants will breach those covenants and will need some relief from their lenders, because the alternative is pushing a lot more working capital into the system to be able to pay bills as they come due. Most mortgage loans for hotels have required FF&E reserves. They're usually for 4 or 5% of gross revenue. Failure to fund an FF&E reserve is oftentimes a default. Failure to fund an FF&E reserve might be a default under the underlying franchise agreement. Lenders are currently being asked by borrowers to free up cash from FF&E reserves to either pay debt service or operating expenses or other necessary expenses. And in a lot of cases, the lenders are granting that within some limits. You must make sure that that is also compliant with the franchise agreement. And you should be mindful of whether the lender is intending for you to replenish those reserves at some point in time in the future, because that cash will have to come from somewhere. Many mortgage loan agreements have provisions for other reserves. That might be for property taxes, insurance, ground rent, seasonality, or even PIP completion. Borrowers are asking lenders right now for flexibility to tap into those reserves, and lenders are granting some of those requests on an interim basis because lenders are going to want to make sure that there's somehow enough money to make the annual property and casualty insurance premium payments. They'll want to make sure that there's enough money to make property tax payments to the local municipalities. So they may be willing to do some waiver in the short term, but they're going to be very focused in the medium to longer term on making sure those reserves are replenished, or that the borrower is providing some sort of guarantee to make those payments. Many loans have provisions for extensions or covenants that are loan to value, LTV tests, and some of them are based on an appraised value concept. So the issue today is, even if you wanted to get an appraisal, how could you? Many appraisers are not traveling. It's unclear how to calculate value. It's unclear how a borrower could actually satisfy that financial test if they needed to. So to the extent that there's an extension test or some other financial covenant that may be breached related to an LTV or an appraised value, that's something that lenders should be asked for relief on. Most loan agreements and guarantee agreements have net worth and liquidity covenants. And given this environment, it will be very difficult to gauge and to calculate and determine the net worth and the liquidity of the borrowers and of their guarantors. There are a lot of things where value is not readily ascertainable, where liquidity is being quickly used and drained to deal with immediate cash expenses. There will be heightened scrutiny in any loan renegotiation or restructuring over the liquidity, especially. Over net worth, yes, but over liquidity, especially for guarantors and for borrowers. Permitted indebtedness is also important and sometimes overlooked. So loan agreements generally have limitations on the amount of trade payables that someone may have. In this current environment where payables are being stretched to manage cash flow, and where there may be payables to management companies, franchisors, and others that are also accruing, you may find that you as a borrower or your borrower client is breaching or is exceeding the amount of approved trade payables. That is a default or could be a default under the loan agreement. Loan agreements also almost always have restrictions on taking on additional indebtedness. So you cannot take on another loan without lender approval. Many borrowers, many hotel owners are going and applying for PPP loans under the CARES Act. Taking those loans would in most cases violate the underlying franchise agreements. So make sure to get approval from your lender to be able to take that loan without violating the terms of the loan agreement. Loan agreements generally have provisions for the completion of PIPs, for the timing of completion of PIPs, or any construction work. Many of those deadlines are going to have to be extended because a lot of construction and a lot of PIP work is currently on hold or will be on hold. Some of it will be value engineered. Some of it will be renegotiated with the brands. Very important to understand that in terms of renegotiating the PIPs, if the borrower renegotiates the PIP, that's going to be an amendment or modification to the franchise agreement because the PIP is actually attached to the franchise agreement and is guaranteed by the franchisee. The franchisee is generally your borrower. So very important to understand the start date, the end date, and what's happening with PIPs. The brands are being very accommodating right now, but if you're a lender, you lent against a certain collateral expectation and that a certain type of work would be done and that the property would be brand standard compliant. Your borrower may be coming to you saying, we need to waive things, we need to defer things, and you should be very mindful of that as a lender. You should be very mindful of that as a borrower. Some loan agreements have provisions that allow for certain relief or certain modifications only subject to a no downgrade letter. You may find that in pooling and servicing agreements as well. And right now, if a special servicer went to the rating agencies that rated underlying CMBS bonds and said, we need a no downgrade letter, I'm not sure how quick a response they'd be getting. I'm not sure how easy it is for the rating agencies to evaluate certain requests on a timely basis and to factor in all other relevant information and to be able to say, yes, we can issue a no downgrade letter. So that in some cases may be a non-starter, in some cases may just take a long period of time. Oftentimes payment of taxes or non-payment of taxes can trigger a default under the loan, especially if there's cash available to make the property tax payment. Most loan agreements have provisions that you must maintain the franchise agreement. If it's a branded hotel, that you would preserve and protect the franchise and all trade names. Certain actions taken might actually jeopardize that franchise agreement. There are provisions generally to maintain the property in safe and good condition. It's unclear in this COVID-19 environment what that actually means. Is that just physical property? Is that additional provisions should someone get infected or sick at the property? So that's a little unclear and will probably in the future be the subject of some argument back and forth. There are provisions for the performance of other agreements where a lender is requiring a borrower to be compliant with underlying parking agreements, F&B operating agreements, other lease agreements, and failure to remain compliant with those agreements could be a default under the loan. So as you're going as a borrower and an operator through crisis control maneuvers, make sure that your lender is on board if you're terminating or suspending or modifying any of these other material agreements. There are provisions in loan agreements for hazardous substances where the hotel must be free of hazardous substances and dangerous conditions, where dangerous conditions and hazardous substances have to be reported to the lender. So it's a little unclear, and you should look at your specific agreement and check with your counsel as to whether you must notify your lender if someone tests positive or you believe someone is positive for COVID-19 at the hotel and what that means. There are provisions in loan agreements related to material leases. So a lender has to approve of a material lease. Very important as we're working with a lot of clients on the potential to lease out entire hotels or entire floors to municipalities, to medical systems, to first responders, and doing that in a lot of cases will require approval of the lender. Minor leases. There are oftentimes provisions that minor leases are pre-approved as long as they follow a specific pre-approved form with the lender, have subordination provisions and other provisions. So very important if you're leasing out a portion of the premises to make sure that you're compliant with the minor lease provisions. Many loan agreements, probably most loan agreements, have a change in use provision, which preclude which preclude the borrower from changing the use of the hotel without lender consent. So if you were a transient operating hotel and you rented all of the rooms out under one master lease to a healthcare system or to a fire department or to any other large group, that might be construed as a change in use. Management agreements. Loan agreements have restrictions on the ability of a borrower to modify or amend or change key terms of management agreement. So when you go to your operator as a borrower and ask for forgiveness or relief, that could be construed as an amendment to the management agreement and may require lender approval. Similar with the franchise agreements. If you get relief on certain fees, if you change any key terms, even if you change the PIP, which is an exhibit to the franchise agreement, that can be construed as an amendment or a modification to the franchise agreement, and that's not okay in a lot of cases unless you have lender approval. Notices are also important. Failure to provide notices on a timely basis or at all, though quite honestly, anyone providing notices today is probably sending FedEx envelopes to empty office buildings. Financial statements. So loan agreements have requirements to provide certain borrower and asset level financial statements and certain guarantor financial statements. Oftentimes when there's a default or in certain circumstances, there's a requirement for additional borrower financial statements. So what might have been certified statements now need to be audited financials. What might have been simple financial statements for the guarantor may need to be audited financial statements. So that's one of the things that you should be very cognizant of and possibly ask the lender for a waiver on. And then there are a number of default provisions throughout. They generally fall into a number of different categories. One is non-payment of interest or principal on a timely basis. That could trigger a default, and that's very much in play in a lot of situations today where it doesn't look like there's enough cash on hand to make debt service payment. The next is non-payment of property taxes, insurance, or other fixed expenses like ground rent payments. Very important for lenders to make sure those things are done so that they don't actually potentially lose their collateral. Generally, non-payment of debts as they come due from a borrower or guarantor can trigger a default. Covenant breaches, operational, legal, financial, can cause a default. Breaches of net worth and liquidity covenants for a borrower could trigger default. And then modifications of agreements and failure to get approval for other agreements. So in addition to the actual loan agreements, there are all sorts of ancillary documents and agreements, some of the most important of which are the guarantees. And most loan agreements have numerous guarantees, and you should be very careful and get specific legal counsel and help to help understand what the guarantees actually say. Oftentimes, there are guarantees for carry costs, for interest expense, for real estate taxes, for property and casualty insurance payments. There may be guarantees for repayment of a loan. There are oftentimes guarantees for environmental issues and damage and harm. And then there's what are called the non-recourse carve-out guarantees. They're also referred to as bad boy guarantees. And if you do a number of things under those guarantees, it turns what would have been a non-recourse loan into a recourse loan, where the borrower or the guarantor is personally liable for the interest, for all losses, for repayment of principal under the loan. These can be very significant, and over the last decade, a lot of the non-recourse guarantees have been broadened in their scope. So, that might have been glossed over while your loan was being done. Pull out those guarantees, make sure you understand what they say so that there's not a lot of personal liability and exposure. Get advice from your financial advisor, get advice from counsel. Again, everything that I went through is illustrative. It's all designed to be informative. Every situation is unique. Every loan document is different. Every borrower-lender relationship is different. If you would like help understanding your loan documents and help with your negotiations with your lender or with your borrower, feel free to reach out to me at jonathan@jfcap.com or at telephone 917-238-6910. 17. I know there was a lot to go through. It's a very complicated topic. I hope everyone stays safe, and we look forward to seeing you on the other side of this.